Yes, sir.
Okay, thank you. Good afternoon and welcome to this afternoon session today, which is going to be on basics of accounting and finance. I'm going to touch upon what are the basic concepts, the general understanding of basic terms that we use in accounting and finance, and how accounts are maintained by the businesses, and what is the relevance of maintenance of accounts and how to deal with finance matters so far as the business is concerned. And as yesterday, towards the end of my session, I will also share some sample multiple choice questions with you on basics of accounting and finance so as to give you an idea as to what kind of questions to expect in the examination. So far as the number of questions go, minimum 3 questions, maybe 4 from this particular section can be expected in the exam, the evaluation exam. So let's get started with basics of accounting and finance in today's afternoon session. You know, someone who passes out from a college has two options virtually. One is that he may probably like to get into some kind of a job, or he may like to go into some kind of a business or profession. Once someone decides to get into a business or a profession, then the question arises, what kind of structure or what kind of business structure should he choose which will best suit his requirements in terms of carrying out the business or the profession? So, what are the options available to him in terms of choosing the business structure? Well, to start with, he can perhaps decide or she can perhaps decide to go on a sole proprietorship basis. That means you want to go it alone because that is where you have maximum control over all operations. You are your own controller, you are your own king, and there's nobody else that you got to bother about. Of course, you may employ certain people as employees, but nonetheless, you are the sole master of your business or profession. Great advantage of having a sole proprietorship, but the negatives are that since you are going to have a business on sole proprietorship basis, there are obviously going to be limitations in terms of your time, in terms of your competence, in terms of the amount of fund available, in terms of your marketing ability, in terms of your business acumen. There are obviously going to be some limitations in that context. So if you decide to go on a sole proprietorship basis, you can of course grow your business up to a level, but the business will not go beyond a level. Or in other words, if we just take an analogy or an example, you can probably never become a Reliance. You are not even a smaller company for that matter. Reliance is a giant in the corporate sector, but not even a smaller company because of various limitations. One another disadvantage of having a sole proprietorship is that business is risky. We also discussed yesterday that profit is the reward for risk that an entrepreneur takes. If the business doesn't do well and you have incurred some market owings, that means you have to pay some money to the market people, to some people in the market. You will have to shell out your private funds to an unlimited extent because nobody will leave you just like that only unless all their dues have been duly paid out. In technical financial terms, we call this as the concept of unlimited liability. You may have started your business by putting 2 lakhs, but at the end of 2 years, probably you may find that business has not been doing well and you owe rupees 5 lakh to people in the market. You will have to bring 3 lakh more from your personal sources, whatever. You will have to clear all your dues because otherwise people will just not leave you just like that. So there is a problem of unlimited liability in case someone decides to go for a business on a sole proprietorship basis. Second is probably you can decide to form kind of a partnership. Partnership can be formed by minimum of two persons and a maximum of 20. There cannot be more than 20 partners in a partnership form. This is as per the Indian Partnership Act of 1932, which regulates partnership entities in India. But the advantage there is that you are not alone. You are having your partners who will support you in your business, both operationally as well as by way of providing finance or funding. So your size of business can be bigger because you have 10 people, 12 people, 15 people, 20 people to support your business. And to that extent, the availability of funds will also be reasonably satisfactory, reasonably comfortable. But the problem still remains that of unlimited
Sir,
liability.
if it is more than that,
Sir,
if it's more than 20, then
sir, it will not be a legal entity in that case. According to
one
Indian
small
Partnership
submission,
Act
sir.
1932, a partnership cannot have 20 partners. If you have more than 20 partners, then it's kind of an illegal entity because that's the law. So you have to go by the law, sir.
Oh,
You can have a partnership
so you're so maximum 19 or
20,
20?
20, sir. 20,
Is it 19 or 20?
20, but not 21.
Okay, thank you.
So the problem of unlimited liability still remains here. That means if 10 people pool together 2 lakh rupees each and they start a business with 20 lakhs capital, but after 2 years down the line, the business has not been doing well, and you have owings of rupees 10 lakhs in the market, which you have to pay to some people, partners will have to bring additional 10 lakhs from their personal sources. Nobody will just leave them like that only. You will have to bring 10 lakhs more. 20 lakhs is what you had invested in the beginning, but you will have to bring 10 lakhs more from your personal sources. Then only you can probably decide to close out your business, but only after clearing all the liabilities of the market. But then there is another structure available, which is called LLP, Limited Liability Partnership. That structure is provided for under Companies Act 2013. Companies Act 2013, where you can form a partnership, but at the same time, the liability of all the partners is going to be limited and not unlimited. So it provides you a mix of the two, the benefit of partnership, but at the same time, restricting your liability to the amount that you have contributed initially. If you form a limited liability partnership, in that case, taking the same example forward, in case someone had started off a business with 10 partners, each one of them contributing 2 lakhs, starting with a capital of 20 lakhs, and after 2 years, you have owings of 10 lakhs in the market, you need not pay those 10 lakhs to those outsiders because yours is a limited liability partnership. No partner can be required to bring additional capital. Only what happens is whatever amount you had contributed in the beginning, that probably might become zero. That might become a dead loss for you. But nobody can ask you to contribute more than what you had already contributed while starting off the business. That's the advantage of the use of the word limited liability partnership. That means your liability becomes limited. Similarly, again under the Companies Act, you can also probably decide to form a company. Broadly, there are 2 or 3 different types of companies. You can have a private limited company or a public limited company. A private
One doubt, sir.
limited, yes, please.
Sir, suppose if they borrowed, suppose there is a loss of 10 lakhs in the LLP.
Yes,
So, if there is a loan of 10 lakhs from outside,
yes,
so suppose if the members need not to contribute anything, then how
absolutely.
to clear out the debt? 10
Whatever
lakhs.
whatever assets in case the company has, or in case the partnership business has some assets, some shop, some office, some car, some building, some stock, whatever, The bank can sell those assets and realize whatever is possible. But beyond that, the bank cannot realize anything.
Okay.
Because the concept of limited liability partnership. So you can form a private limited company or a public limited company. A private limited company can be formed by minimum of 2 members, and the maximum number possible there is 200. 2 and 200. You can form a private limited company. It's a company, not a partnership. Maybe all, maybe few people will contribute funds for the business, and then the business will be owned by all these 200 or 150 or whatever number of people. You can have people who are employed in the business as employees, but the business will be controlled, run, and owned by these members who can be maximum 200 in number. Now, here, if you have a business with 150 people contributing money or 200 people contributing money, obviously the size of the business is going to be pretty large. It's going to be much bigger than partnership, much bigger than sole proprietorship, because you have more number of people associating together, providing funds for carrying out of the business. And the advantage here is same, limited. Whenever you have a private limited company, the name of the company ends with the word private limited. So if you have XYZ private limited, the word limited, last word is limited. Limited word implies that the liability of all the people who are owning this particular company is limited. Limited to the extent of the capital that they would have introduced into the business on voluntary basis. Even if there is more loss, they cannot be called upon to contribute towards meeting of that loss because it's a limited liability structure. So you can form a private limited company. Comparatively speaking, limited liability partnership is simple to operate and manage. There are fewer compliance requirements, but a private limited company will have comparatively more compliance requirements. So you need to probably engage a company secretary or you need to engage a professional to be able to comply with all those statutory requirements which are provided for in case of a private limited company. Then you have a public limited company. That option is also open to you if you want to start a business. A public limited company can be started by minimum of 7% and maximum there is no limit. Reliance today has more than 35 lakh shareholders. Similarly, other big companies have lakhs of shareholders who have contributed money by way of investing in the shares of the company which they have purchased from the stock market. But then maximum there is no number, no limit, but minimum there have to be 7% to start off a venture by way of an organization structure which is called a public limited company. Most of the big businesses that we have in the marketplace, they are structured around the concept of public limited company. And the advantage
Sir,
here is same. Just a minute, please. Advantage here is same. The liability of each one of the shareholder is limited to whatever amount you have contributed. If someone has purchased only 100 shares for rupees 1000 probably, even if the company gets into liquidation or if the company gets into loss, maximum what will happen is your 1000 rupees will become zero. But you cannot be called upon to contribute anything more than that because you are a member of a company which has a limited liability concept. Yes, please.
sir, it needs to be a production company or it can be
Any
service
company, sir.
oriented also?
Nature of business is not material, sir. It can be into any kind of business, whether consulting or profession or manufacturing or trading or export, whatever.
Service.
Service,
Sir, in
anything.
LLC, how many members are permitted?
To unlimited, sir. Public limited company, unlimited.
No, no, LLP, limited liability partnership.
Limited liability partnership, because it's a partnership primarily, so 2 and 20.
Same as private limited.
Same. No. Private limited company, 2 and 200.
Okay.
Yes, sir.
Like same as partnership.
Yes, sir. Yes, sir. So
Sir,
these
I have
are
a question.
yeah.
In terms of private limited or public limited, shares are issued to the owners of the company and the Basically, yeah, the owners of the company. How does the shares are related to the liabilities?
Okay. In public limited company, the advantage is that the shares can be issued by the company to owners as well as outsiders who
Correct.
will then become the owners of the company when they purchase those shares. In other words, you would have heard the word public issue.
Yeah.
Many a time companies come out with public issue, commonly known as IPO, initial public offering. When
Yeah.
the company offers its shares for sale by way of open advertisement in the newspapers or TV or television or whatever, and then people can put their money by way of investment.
Absolutely.
Whosoever puts the money there, whatever amount you decide to put, say if you want to buy 50,000 worth of shares of a company, your investment in the company, your stake in the company is to the extent of 50,000.
And
Maximum what
shareholders.
might happen is, in case the company gets into liquidation, the company gets into loss, you will not get anything back. Your 50,000 becomes zero.
Zero.
But you will not never be required to contribute even one single paise more than that because of the concept of limited liability partnership.
Okay.
Sorry, limited liability company.
Company.
In the case of a private limited company, the company is prohibited, not allowed to issue shares to general public.
Right.
A private limited company will have shares, but these shares can be issued only to a maximum of 200 people who are going to be the members or owners of the company. But a private limited company cannot come out with a public issue, is not allowed to come out with IPO, is not allowed to issue shares in the open market. That's the
And,
basic difference between a public and a private
and their liability is limited to
company.
shareholders.
Limited, sir.
Okay.
Liability is limited, yes.
Thanks, sir. Thanks.
So these are different options available for someone who wants
Capital
to.
restraints.
Anji,
Sir, one
What
submission.
is
One submission, sir. Public
yes.
limited company needs how much budget minimum?
How much?
Budget is required. Funding is required.
Minimum funding 1 lakh, sir.
From
1 lakh for private. So just a minute, sir. 1 lakh for private limited and 5 lakhs for public limited. 5 lakhs.
okay,
what
5
is
lakhs.
Yeah.
When
what is
we can issue public demand, public shares? When can
In
we?
public limited company only.
Okay. With the budget total, there are say
No, no.
100 people. Sir, there are say 100 people, public limited, and each
Yes.
contributes 1 lakh. So it become 1 crore.
Yes.
So how to issue the public shares?
No, no. You have 1 crore, but going forward, as your business grows, 1 crore may not be sufficient. You may require more funds. You may require 100 crores. So, where from those 100 crores will come? The company can then issue shares in the open market. Whosoever wishes to invest, me, you, anybody in the market who wants to put his money in investment, they will buy the shares of your company and provide you funding for that.
Is there any limitation
No limit.
to issue public issues?
No limit, sir. No limit.
If the owners of they say, I said no, about 100 people, they have shared about 1 crore. So
Yes.
to how much amount shares can be issued?
Any amount, sir. It's not limited to the initial capital.
Oh
Whatever
my.
amount has been contributed by the owners initially doesn't matter. It can be as small as 15 lakhs, 20 lakhs, 50 lakhs. But when the company wants to issue public shares in the open market, it has to decide how much money is required by the business. Obviously,
I,
you will not require more than what you require for the business. You will issue shares only to that extent. But that's a choice given to the company. But there are regulations. SEBI, you would have heard of SEBI, Securities Exchange Board of India, regulates the issue of public shares in the open market. So the company which wants to issue open shares, they have to first take permission from SEBI. And there are certain regulations, certain guidelines which are required to be followed by every company which wants to issue shares in the open market.
Sir, I have
One more thing. What is the listed company and unlisted company? Sir?
Once a company issues its shares in the open market, and which can be done only by a public limited company, then these shares start getting dealt with, bought and sold at the stock market, at the stock exchange. Then the shares are said to be listed. Listed means the shares will get listed at the stock exchange, where somebody can sell, somebody can buy. It's a market. It's a stock market. Just as there is market for anything else, it's a stock market where shares of different companies are bought and sold. So once a company issues public shares, then the shares of the company gets listed at the stock exchange, and the company is called a listed company. But a
Though it,
private limited company cannot issue shares in the open market. Therefore, all private limited companies are unlisted companies.
even
They have
limited
shares, but their shares are not listed at the stock exchange.
even limited company also not under listing, no? Certain companies.
Quite possible, sir. A public limited company may decide to only do business with 1 crore contributed by its owners and not go for public issue till such time it will remain an unlisted company. But as soon as you come out with a public issue, your shares get registered with the stock exchange, then the company becomes a listed company.
Right, sir. Thank you.
So to simplify, a private limited company will always be an unlisted company. A public limited company can be unlisted or listed, depending upon whether company has come out with a public issue or company is solely depending upon the funds contributed by the initial owners only. So whatever structure you may decide to follow for carrying out your business, the first statement here, finance is the lifeblood of business. How successful, how big your business is going to be or likely to be, it to a quite extent depends upon what is the requirement of funds for the business, and do you have adequate capital, do you have adequate amount of funds available with you or not. That's going to be a key to the success and sustainability of your business. All business operations have a financial aspect. Whether you take marketing, whether you take production, you take operations, you take logistics, whatever, all business operations, they have a financial aspect. All business operations will involve either a cash inflow or a cash outflow. Money coming into the business is called cash inflow. Money going out of business is called cash outflow. All business operations will have either a cash inflow or a cash outflow, or maybe both in certain cases. So the operating managers, in the company you have a marketing manager, you have operations manager, you have HR manager, you have technical manager, you have a stores manager, you have finance manager. Now, finance manager obviously has to have deep understanding of the accounting and finance, but even other managers must have some basic orientation of finance, because anything that they do in the company, whatever function they are concerned with, it has to do something or the other with money or with finance. That's the requirement. So that is why in your syllabus also, this small capsule of accounting and finance has been kept. Even though you may not belong to the discipline of accounting and finance, but a basic idea of accounting and finance is required by everyone. Whosoever does his own profession, does his own business, works for a company, everyone requires a basic knowledge of accounting and finance. Operating managers.
Sir, I have one question.
Yes, please.
Can I put, sir? Sir,
Yes,
I am
please.
dealing with private limited company and public limited company for funding purpose. And for this, I asked them to submit their annual report. Some companies submit their annual report in printed format. Some said that they are not listed. They are not supposed to submit in ROC. So they are submitting their only 4 or 5 pages or 10 pages. So
Yes,
in
please.
this regard, ROC, in the
Yeah.
concern of ROC and annual report, what is the scenario? Please clarify.
For private limited and unlisted public limited companies, there are no guidelines of SEBI or stock exchange, so they can prepare their annual report in 4, 5, 7 pages, whatever you are saying right now. But for a listed public company, there are various comprehensive guidelines where the annual report will run into quite a few pages, maybe at least 50 pages, 40 pages, because they are required to disclose various information as per the guidelines of SEBI as well as stock exchange. So for private limited and unlisted public limited companies, no guidelines. So they can have their annual report in just 4, 5, 10 pages. But for listed public limited companies, there are very comprehensive guidelines of SEBI and stock exchange. Therefore, the annual report will be always very, very comprehensive.
Sir, maybe outside the subject, one
Thank
more
you.
doubt, sir.
No problem.
Sir, how will you fix the share cost, each share?
Share is like any other product. If you are doing a business and you are manufacturing a product, we discussed in economics also yesterday, the basic question that needs to be answered by the businessman is, how much price should I keep for this product? The price should not be too high so that people will not buy. A price should not be too low so that you will lose profit. The price has to be just optimal. But then the basic question, how do I determine the optimum price? We discussed in economics yesterday that today we live in a world where there are hardly any monopolies. Hardly any monopoly. There is always a substitute complementary product available, similar product available in the marketplace. So one way to look at it is look at alternate product available in the market. What is the price? That provides you some kind of an indication or some kind of a benchmark, and then you can adjust your price slightly above or slightly lower than that. That's how you do pricing of your products. Similarly, when you have to issue shares in the public, shares in the market, and you have to determine how much price should I keep for a particular share, you have to look at comparable companies. Other companies which are more or less comparable to your in terms of size, in terms of nature, in terms of business model, how much is their share? You have to keep your price slightly above or slightly lower than that. That is the only way by which you can find out a true mechanism of fixing the price for your particular share. Otherwise, there's no formula. It is a judgment. You have to make a judgment, and it's a judgment call based upon analysis and understanding of comparable prices of shares of those companies which are comparatively comparable in terms of their business model, in terms of their turnover, in terms of their nature of business. So, operating managers, yes, please.
I listened that the initial share is 10 rupees.
Yeah, that's right. 10
Is
rupees
there any
normally.
limitation? Is there any such limitation, minimum 10 or minimum 100 product
No,
wise?
no, sir. No, sir. You can keep the share price anything, but if you want to go into finer details, then there's the concept of a face value. Every share will have a face value. Normally, companies by concept, by tradition, by custom, they keep 10 rupee as the face value of the share. And in case the company is issuing a share in the market at 25 rupees, then it will have two components. 10 rupee will be called face value and 15 rupee will be called premium. If you are issuing shares for rupees 400, the company may still decide to have a face value of rupees 10, then the component will be 10 and 390. 10 rupees will be called face value, 390 will be called premium. But there is no fixed norm to have a 10 rupee face value. A company can even have a face value of 1 rupee. But the minimum 1 rupee is what is laid down by law. You can't have it in paise. It cannot be 50 paise. Minimum it has to be 1 rupee. But traditionally, as per custom, companies normally keep their face value as either 1 or 10 or 100. Thank you.
Thank you, sir. Thank you.
Operating managers need to
Thank you,
be
sir.
equipped with financial decision making acumen which will help them to make good decisions in the business with regard to pricing of the product, with regard to cost reduction, and with regard to make or buy decision. Many a time in the business, you are faced with the dilemma of deciding, should I buy this component from outside or should I manufacture this component myself within the company? How to make that decision? That decision will be based upon cost benefit analysis, CBA. So you carry out cost benefit analysis of the two alternatives, making in-house or buying from outside. Whichever one appears to be more financially sound, you go for that particular decision. So finance is useful. Basic understanding of finance is useful for all operating managers of the business. So what is finance? Finance is the study of how people and businesses evaluate investments and raise capital to fund them. Basic question, how to get and use money. Same for personal finance. We work for companies, we do consulting, we are into profession, we earn some income, we have a family budget, we decide where to spend, where not to spend, we decide investments, short-term investment, long-term investment. That also we all do in our personal life. Similarly, in the life of a business also, we are always concerned with this question, how to get the funds which I require for my business and how to use that money most effectively, most judicially. What is corporate finance? There is personal finance, which deals with how an individual should deal with his financial matters. How should he prepare and manage his family budget? How should he save money? Where should he invest saved money? Should he invest in long term or short term? All these are part of personal finance. Then there is the concept of corporate finance, where we deal with how companies deal with money, how companies collect money, how companies raise money for their business, how they make investment decisions. If a company has to come out with a new project, how do you decide whether should I put this money in this new project or not? How do companies decide to go abroad? If you want to set up a subsidiary company in some other country, how should you decide based upon the requirements of money and investment? You will take a call. Should the company go for investment outside India or not? All this is going to be part of the corporate finance. Three questions are addressed by the study of finance. What long-term investments should the firm undertake? This is covered in the concept of, in finance, there is a separate chapter given in all the books, which is called capital budgeting. This is called a capital budgeting decision. Whenever you look for long-term investment, then that is called a capital budgeting decision. You have a revenue budget and you have a capital budget. Revenue budget or short-term budget is paying salaries, paying rent, paying for traveling, paying for telecommunication, mobile expenses, things like that. But when we talk about a capital budget, it refers to budget for long-term investments made by the company. So you have to decide how to spend money on long-term investments, how to spend and invest money on various projects, which projects to undertake, which projects to shelve, which projects to avoid. All this is part of the concept of capital budgeting decision. Second is, how should the firm fund these investments? How to get the money? That is called in finance capital structure decision. There are broadly two ways in which a company can raise money, either by way of issue of shares, that means share capital, or by way of raising money by way of borrowings. Borrowings from bank, borrowings by way of issue of bonds and debentures. The difference between shares and debentures is that in case of a debenture, the company has to pay interest because it's kind of a loan. But on the money collected by the company by way of issue of shares, the company is not required to pay interest because it's not a borrowing. The company has to pay dividend to the shareholders. Dividend. So on the shares, the company has to pay dividend. On the borrowed money, the company has to pay interest. Interest has to be paid mandatorily whether there is profit or loss in the company. But dividend may be paid only when the company has a profit. In case company has a loss, the company is not mandatorily required to pay dividend to the shareholders. So shareholders might have to go without any return at all for quite a few number of years in case the company is not profitable. But somebody who has put his money in a company by way of investing into bonds and debentures, or somebody who has given money to the company by way of loan, will definitely get interest paid him even if there is a loss in the company or even if there is a profit in the company. Third aspect of finance is how can the company best manage its cash flows on day-to-day basis. This is called working capital management decision. You require funds for running of your company on a day-to-day basis. You have to make purchase of some stationery item, some mobile recharge will have to be done, monthly rent will have to be paid, salaries will have to be paid to the staff, some traveling expenses will have to be incurred, some advertisement expenditure will have to be incurred, raw material will require to be purchased, some machinery will have to be repaired. All these are part of your day-to-day operations, which is part of working capital management. What is accounting? Accounting is the language of business. How good your business is doing, whether your business is doing good, bad, satisfactorily, not satisfactorily, everything can be understood and properly appreciated by understanding and looking at the accounting of the company or accounts of the company. So accounting is the language of business.
Sir,
It is a
one
system.
submission.
Yes,
Sir, one
please.
submission. Thank you, sir.
Yes,
How
yes,
will
please.
you, if the shares is there, it's not debenture, you said dividend will be paid. Is there any formula to pay dividend?
No, sir. Dividend may be paid, may not be paid. There is no compulsory requirement of paying dividend to the shareholders every year. It is at the discretion of the board of directors of the company. If there is profit, they may decide to pay dividend. At what percentage, that also is left to the discretion of the management. There is no formula.
Then how
In case
the
there is a
profit
loss,
come forward?
there's no formula. Board of directors, they are the ultimate controllers of the business. They will look at how much profit the company has made, how much dividend can be paid this year, maybe 15%, maybe 30%, maybe 200%. And if there is a loss, obviously there is no question of payment of any dividend for that particular year. Payment of dividend is not mandatory, and there is no formula which tells you how much dividend should be paid in a particular year. It is left to the discretion and decision of the board of directors of the company.
Okay, sir. Thank you.
Accounting is a system of recording, summarizing, and analyzing financial transactions. I think next slide will make it more clear. Need for accounting is any business, managers, investors, and other stakeholders want the answer to two important questions. Everybody who is connected with the business as a stakeholder, maybe as an investor, maybe as a government, maybe as society, everyone wants to know two questions. How well has the company performed in the last year? And where does the company's business stand today? So we are able to answer these two questions through the system and mechanism and architecture of accounting and finance. We prepare a balance sheet for a company. We prepare an income statement, which is also called a profit and loss account every year. And we prepare cash flow statement. By these three statements that we prepare, everything becomes clear as to how good the company is doing, how well the company is running, is the company profitable, not profitable. Everything becomes clear by proper analysis and understanding of these three basic accounting statements: balance sheet, profit and loss account, and cash flow statement. I'm going to give you more details about each one of these statements in later part of my presentation. There are two broad accounting disciplines: financial accounting and managerial accounting. Financial accounting, the focus is on external users, bankers, stakeholders, shareholders, debenture holders, government. They are more concerned about financial accounting of the company. But there's another aspect of accounting which is called managerial accounting. The focus of managerial accounting is on internal users, the management, the owners, the employees. They would also like to know from time to time how well is their company performing, And managerial accounting helps internal users of the company to get a handset with regard to the functioning of the company on an overall basis. What are the steps involved in accounting? The first step involved in the accounting process is identifying a business transaction and recording of the transaction in an accounting book, which is technically called a journal. Accounting means you can't simply keep everything in your mind. Even you have huge memory as individuals, as human beings. We have huge memory. We can remember quite a lot of things, but at the same time, business will have numerous transactions, many transactions. Some transactions where the money will come into the business, some transactions where you will make the payment. It is difficult to remember each and every transaction just like that only. Therefore, in accounting, we write down everything. We write down all transactions that take place in the business, and a particular book in which we write these transactions is called journal. Journal is also known as the book of first entry. For the very first time, your accountant who works for you will make an entry of a transaction. The book in which he will make the entry is technically called a journal. The entry can be made manually or virtually. Manually means you have a physical record. It will be a register in which you will make the entry by your hand. You will write with your own hand with a pen. Or you can use a software, Tally, which is the most commonly used software for accounting, where accounting is done on computer. So you don't have a pen and paper, but you do accounting on computer. But even on computer and even on a manual basis, you will make the first transaction entry in a book which is technically called a journal. The next step is posting in the ledger. The second book of account. If you start a new business and you want to maintain your accounts, you hire an accountant. He says, sir, I need books to maintain accounts. I asked him, what kind of books do you require? He says, sir, kindly get me a journal and get me a ledger. I said, I don't know. What is the journal? What is the ledger? He said, go to a stationery shop, ask them, kindly give me a journal, kindly give me a ledger. Sir, they will give you. So I go to a stationery shop, I ask for a journal, he gives me a register with certain columns made there, and then I ask for a ledger. The shopkeeper gives me a ledger also. I bring it back, give it to my accountant is very happy. What is the ledger? In ledger, what we do is we group similar transactions together. If I have purchased raw material 10 times during a month, I put all those 10 transactions of purchase of raw material in one place, on one page. If it is not coming on one page, maybe second page, but at a particular place in that ledger. If I have to pay salaries paid to my all the people who might be working in my company, I put that in one place. I make group of transactions, not isolated, not scattered here and there, but I make group of transactions. All transactions which are of similar nature, I put them all together in one group, in one place, so that it becomes easier for me to understand my business. If I put all 10 transactions of purchase of raw material during a month, I know how much worth of raw material I have purchased during the last month. If I put all salary transactions in one place, I know how much salary have I paid for the last month. If these items are scattered here and there, then it will be difficult to find out total amount paid for raw material purchase or total amount of salary paid. So ledger is nothing but it classifies various transactions so that similar transactions are grouped together at one place. Then there is a concept in accounting known as trial balance. If I want to check whether my accounting is correct or not correct, Has my accountant done the accounting on a correct basis or incorrect basis? There is a concept of trial balance which will tell me if there is a mistake in accounting. It's kind of a check. It will throw up that mistake so that I can tell my accountant, please look here, your accounting is not correct. There is some mistake. Please check, please clarify, please rectify. And then we prepare profit and loss account at the end of a year, which will have income and expenditure. All the income that the business has earned during a year will be put there. All expenses incurred by the business will also be put in the profit and loss account. And then if income is more as compared to expenditure, then the business will have profit. Vice versa, if expenditure is more and income is less, that will show loss for the business. Then I have balance sheet. Balance sheet includes the position of various assets and liabilities of the business. Profit and loss account shows income and expenditure. Balance sheet shows assets and liabilities. What are assets? What are liabilities? Assets are what the business owns. OWNS. What the business owns. Land, building, plant and machinery, furniture fixture, stock, stores and spares, inventory. All these are assets. Liabilities are what the business owes. OWES. What the business has to pay to outsiders. Those are called liabilities. Liabilities will also be either short term or long term. In accounting, we follow a concept that a liability for a period of less than 1 year is identified as a short term liability or a current liability, and a liability for a period of more than 1 year is termed as a long term liability. So, balance sheet shows the position of assets and liabilities of the business, whereas profit and loss account shows income or expenditure of a particular year and the resultant position of profit or loss for the company. So there are certain important terms that we use in accounting: profit, cash flow, assets, liabilities, income, expenses. What is profit? Difference between income and expenditure. This is also called accounting profit, because you remember yesterday we also talked about economic profit, and the example that I gave you there was that person starting off his business in a garage, not paying any rent for that. So if you don't pay rent, then in accounting profit, that rental component will not be considered. The profit in accounts is calculated only on the basis of what is the actual income of the company and what is the actual payment that has been made. No notional payment is considered here. Whereas if you calculate economic profit, there you also take into account notional expenditure or implicit expenditure. Then you have cash flow. Money coming into the business, money going out of the business is called cash flow. So obviously, we can have cash inflow where the money comes into the business, and we can also have cash outflow where the money goes out of business. Cash inflow, cash outflow. Assets can be either fixed assets or current assets or intangible assets. Fixed assets are those assets which have a long service life: land, building, plant and machinery, furniture and fixture. All these are fixed assets which provide service to the business for a long period of time. Fixed assets can be either tangible or intangible. Land, building, plant and machinery, furniture and fixture are tangible assets. But the fixed assets also includes patents, trademarks, copyright, brand, logo, all these are fixed assets because they also provide long-term benefit to the company, but they are intangible in nature because we can't see them, we can't touch them, they have no physical existence. So fixed assets are those assets which provide long-term service to the company, but fixed assets can be of two kinds, tangible and intangible.
Sir, where we keep software?
Anji?
Sir, where we keep software? Intangible or
Intangible,
tangible?
intangible, of course. Yes. Then we have current assets. Current assets are those assets which are short term in nature, which are either in the form of cash today or which would get converted into cash within a period of next 12 months. They are categorized in the category of current assets. So, what are the examples of current assets? Cash in hand, whatever cash you have in your business right now in your cash box, cash at bank, whatever amount that you have in your bank account today, the bank account open in the name of the business, whatever balance you have in the bank account today. Then you have debtors. Debtors are people to who you have sold goods on credit basis. You have done some work for someone, but the payment is yet to be received. Those people are called debtors. But the question is, how long will you wait for your payment? How much time period you will give credit? Maybe 15 days, maybe 1 month, maybe 2 months, maybe 3 months, definitely not more than 1 year. So the amount that you have to collect from your debtors, people for whom you have done some work, but they have not yet paid you, it is also likely to be realized, most likely within a period of 1 year. Then you have inventory. Inventory can be of three types: inventory of raw material, inventory of finished goods, inventory of work in progress. Work in progress, WIP. These inventory items are also part of your current assets because the raw material that you have in your business today, it will definitely be utilized within the next 12 months period. Whatever stock you have in your business today of finished goods, it is most likely to be sold out within a period of next 1 year. Therefore, they are also categorized in the category of current assets. So current assets are those assets where you have some asset in the form of cash today or where you are likely to recover cash within a period of the next 12 months.
Sir, excuse me.
Yes, please.
Sir, just in case the debtors or whatever raw materials is not utilized within the year, it can be carried to the next year, right?
It can be definitely carried to next year, sir. Definitely.
Still, they are called current assets only in the
Still they'll
previous
be
year's
called
balance
current
sheet.
asset. Yes,
Okay,
please.
sir.
Yes.
Okay, sir.
Then you have two kinds of liabilities. I just now told you with a threshold benchmark of 1 year. In case you have taken a loan from a bank for a period of 6 months, 7 months, 8 months, 364 days, short term, then it will be called a short term liability. If you have taken a loan from a bank for more than 1 year, or if you have issued bonds and debentures, which are for a period of 5 years, 10 years, 15 years, or even more, then such liabilities will be called long term liabilities. So, liabilities can be either short term or long term, depending upon whether they are for a period of less than 1 year or they are for a period of more than 1 year. Income of the company can be classified in two ways: operational income and other income. Operational income is income arising out of the mainline operations of the business. Whatever the company is doing, what is the mainline operation? Any income that the company generates by getting involved, engaged in the mainline operation of the business will be called operational income. But besides the operational income, the company might also from time to time receive some income which is not concerned with the basic operations. To take a crude example, a company might decide to sell some old stuff, some old furniture, some old newspapers, some old magazines, some old catalogs. We will receive some income, maybe howsoever small it may be. But that income cannot be called operational income because such income is not arising from the mainline activity of the company. It is for some other item. For a company, it is important to have greater proportion of operational income to other income. Just to give an example, suppose a company has total income of 10 crores, 2 crores operational income, 8 crores other income. And there is another company which also has 10 crore income comprising of 8 crores operational income and 2 crores other income. Out of the two, the second company is better. Even though total income of both the companies is the same. But first company, I have a problem. Their operational income is only 2 crores. They are selling their asset here and there and generating some income. That's not good for long-term perspective of the company. I'm happy with the second company because total income is 10 crores. Out of that, 8 crores is the operational income and 2 crores is the other income. I'm happy about the second company. A company is good if it has higher proportion of operational income. Higher proportion of income should come from the mainline activity of the business. Then we have expenses. Yes, please.
Sir, if asset is sold, sir, if asset is sold, then it will come under operational income or other income.
There is echo happening, sir. I have not been able to listen.
Same thing I am.
Yes, sir. His voice is not clear.
I'm not able to listen, sir. Yeah. Okay, let's move forward sometime else. Otherwise, I'll answer this question. Expenses can also be classified into various categories. We have cash expenses, we have non-cash expenses, capital expenses, revenue expenses, deferred revenue expenses. Expenses which are paid in the form of cash. Cash here doesn't mean cash by way of currency notes. Even if you make the payment by internet banking, or you make payment by a check, or you make payment by a debit or a credit card, everything is included in this common generic term I'm using here as cash. So any payment that you incur, any expense that you incur, either by way of cash or a check, internet banking, debit card, Paytm, everything is included in cash expenses. Then you also have certain expenses which are non-cash. You consider a particular expense, but then there is no cash outflow. Money does not flow out of the business. What is the example for non-cash expenditure? Depreciation. When you have a plant and machinery, land and building, furniture fixture, after its continuous use in the business for a period of 1 year, its value will become less. That's a common experience. It will become old. So we have to charge depreciation in accounting. 10%, 15%, 20%. We charge some amount of depreciation. In accounting, depreciation is considered as an expense, but it does not involve any real cash outflow. The money does not flow out of business. You just consider a particular amount to be charged as depreciation. Therefore, depreciation is an example of a non-cash expenditure. You have revenue expenditure, which is kind of recurring expenditure, and the benefit of which is likely to be available to the business for a short period of time. Salaries, rent, travel expenses, advertising, mobile expenses, all these are examples of revenue expenditure. Raw material purchase, revenue expenditure. Then you have capital expenditure. Capital expenditure is expenditure incurred on purchase of items which will provide long-term service to the company. Purchase of land, purchase of building, purchase of plant, machinery, furniture, fixtures. All these are examples of capital expenditure. Because all these assets, if purchased by the company now, will provide benefit and service to the company over a long period of time. That is why they are called capital expenditure. Then there is deferred revenue expenditure. There are certain expenditures which are incurred in the business, which are technically of the nature of revenue expenditure, but the management or owners of the company may, at their discretion, consider them as capital expenditure. In other words, it is possible for the managers and the owners to consider a revenue expenditure as a capital expenditure, but vice versa is not possible. They cannot consider a capital expenditure as a revenue expenditure. But a revenue expenditure can be considered as capital expenditure by the owners, by the managers, and by the finance man. What is the example for deferred revenue expenditure? Suppose new Apple iPhone is coming. Months before that, they will start coming out with big full page advertisements in the newspaper, television, hoardings, everything they will start. They will incur huge amount of money on account of advertisement. Normally, advertisement is kind of a revenue expenditure. But if they incur expenditure so heavy, this expenditure is actually creating a brand for the company in the marketplace, which is going to provide a long-term benefit to the company in terms of creating a brand, or in terms of, in marketing, what we call it, brand loyalty. So the company may decide whatever amount we are incurring as a sales promotion campaign at the time of launch of a new product, we want to consider this expenditure as capital expenditure and not as revenue expenditure. What is the difference between capital and revenue from accounting point of view? Suppose you purchase a machine worth rupees 10 lakhs. It's a capital expenditure. When you calculate profit of your company at the end of the year, entire amount of 10 lakhs will not be part of your expenditure. No, only depreciation of this machine. If you are charging 15% depreciation, then only 1.5 lakh will be considered as expenditure for a machine which was purchased by you during the year for rupees 10 lakhs. But if you consider this machine to be a revenue expenditure, which is not allowed, I'm just giving an example. If you consider this machine as revenue expenditure, then you can consider entire 10 lakhs as the expenditure for that year, and then you finally see what is profit, what is loss at the end of the year. So you need not go into such finer details, but just remember, it is possible to consider a capital expenditure as a revenue expenditure. Law gives you that freedom, but it is not, vice versa. It is not allowed to consider a capital as a revenue, but it is allowed to consider a revenue as a capital expenditure under certain circumstances.
Excuse me, sir.
Yes, please.
Why we have not discussed the cash book?
Sir, there are subsidiary books. We have journal, we have ledger. These are called primary books of accounts. Then there are various subsidiary books: cash book, sales book, purchase book, sales return book, purchase return book, petty cash book. All these are not required, so I'm not going into details, sir, because the syllabus prescribed doesn't want you to go into such detail. I'm only focusing on the broader points, sir.
Thank you.
Yes, sir. What are the fundamental concepts of accounting? Just as any subject, is always based upon and built upon certain fundamental concepts and certain fundamental principles. Similarly, accounting also.
Sir, one submission.
Yes, please.
Expenses section. If there is any transportation or tickets or lubricants,
Revenue, everything is revenue.
Is revenue, sir?
Revenue. Only the purchase cost of the machine, when you buy it for the first time, that will be considered as capital expenditure. After that, its repair, maintenance, operations, everything will be considered as revenue.
Excuse me, sir. When we take advertisement or branding as a capital expenditure,
Yes,
then
sir.
then also we will take the depreciation cost of it in the expenditure for that
Sir,
current
in
year.
that case, it is the nature and concept is similar, but
Sir.
instead of the word depreciation, then we
Right.
use another term which is called amortization.
Okay, sir. Right.
Amortization. Nature is
Amortization.
same. Concept
Nature
is
is
same.
same.
You will take only 15%, 20% of the cost as amortized cost, but depreciation word is used in case of tangible assets.
Yes.
Amortization is used in the case of intangible assets.
Right. Yes. Thank you, sir.
Separate entity concept. Here we are talking about accounting from the perspective of the business. How a business maintains and keeps its books of account. When you decide to set up a business, the business becomes a separate entity altogether. You will open a separate bank account for a business. Say, Mr. X, he decides to open a sole proprietorship company by X and Company. Now, Mr. X already has a bank account, a savings bank account, but he will have to open a separate bank account for X and Company, which will be kind of a current account. What is the difference between a savings bank account and a current account? In case of savings bank account, you don't have overdraft facility. You are required to do only a certain number of transactions. Whereas in case of a current account, in case of dire need of funds, you can go for an overdraft, you can go for a short-term loan, and you can also do any number of transactions that may be required by your business. What is the interest rate that you get on savings bank account? All public sector banks today are paying, I think, around 4%. In current account, there is no interest that you get on your money, zero interest. Because the bank provides you many other facilities. That's why the bank says, I will not give you any interest on current account, but I will give you some other benefits. In savings bank account, you get a 4% per annum rate of interest, but then you don't get the benefits which are otherwise available in case of a current account. Cost concept. That means all assets are shown in the books of accounts at their cost of acquisition. For example, I purchased a piece of land in 2018 at a price of 10 crores. That price of land, it keeps on changing on a day-to-day basis, on a monthly basis. Somebody came and told me yesterday that the price of plot that you had purchased 2 years back is now around 12 crores. About 6 months back, somebody came and told me the price of that piece of plot today is at about 7 crores. The market is down and the price is only at about 7 crores. Now the question is, at what price should I show the piece of plot in my books of accounts? 7, 10, or 12 crores? The principle that we have in accounting is historical cost concept. That means I will show the land in my books of accounts at 10 crores. That is actually what I had paid when I purchased the piece of plot. Whatever its market value may be today, whether up or down, high or low, I'm not bothered. I will keep my foot down. I will maintain my books of accounts based upon the value of the piece of plot as rupees 10 crore only. Let's extend this example to a machine. I purchased a machine for rupees 30 lakhs in 2018. 30 lakhs 2018. At what value will this machine appear in my books of accounts now in 2020? Minus depreciation. If I'm charging 15% depreciation, then 15% depreciation for 2019 and again 15% depreciation for 2020, whatever value comes to be, that will be the value at which I will show this machine in my books of account. So historical cost concept means I will show the assets in my book of account at the price at which they were acquired, subject only to the amount of depreciation that I may decide to charge on a year-to-year basis, which is actually mandatory as per the Companies Act and as per the taxation laws. It is mandatory to charge depreciation on all assets. At what rate you charge depreciation, that is also provided in detailed guidelines in the tax laws. For different kinds of building, different depreciation rates. Class A, Class B, Class C structure, concrete structure, semi-concrete structure. There are different types of tax depreciation rates prescribed under taxation rules, and those rates will have to be applied as per the law of the country.
Sir, just ask a question, sir.
Yes, please.
Yeah, if I'm going for overhauling for the machine, so then that cost, what about that cost?
Overhauling can be of two kinds. What is the end result of overhauling? If you do overhauling, and as a result of the overhauling, the total capacity of the machine still remains the same, then it is a revenue expenditure. If as a result of overhauling, the capacity of the machine becomes more than before, then it is a capital expenditure.
You mean more than design? You
But
mean
your
more than
voice,
design? You mean more than design?
but your voice is breaking. If as a result of the overall, the total capacity gets enhanced, then it is called capital expenditure. If you are only restoring capacity up to the previous level, you are not enhancing it, then it is a revenue expenditure.
Okay, sir.
Monetary measurement concept. In accounting, we record only those transactions which can be measured in monetary terms, in money terms, because accounting is all about numbers. So unless you can specify the value of something in terms of money, there will be no accounting possible. Accounting is possible only for such transactions where you can express a particular transaction in terms of its money value. Going concern. In accounting, the basic assumption that we have is that once a business is established, it is likely to continue forever. We never assume that the business will be closed next year or 2 years later or 5 years later. That is not the assumption. Accounting is done on the basis of assumption that once a business is established, it is likely to continue in the marketplace for an unlimited period of time. There might be problems in the business. Actually, the business might be closed down after 5 years, after 10 years. But then, while carrying out the accounting, the basic assumption that we make is the business, once established, will run infinitely in the marketplace and will not be closed down. Revenue recognition. You have to be very sure when to recognize the revenue, when to recognize the income of the company, which is connected with the previous concept of accrual concept. Suppose you buy some raw material on 30th of March. Raw material has come into your factory, but according to the agreement with the supplier of raw material, I enjoy a 2 months credit period with him. I have 2 months time to actually make the payment. Raw material has come into my factory on 30th of March. I have accepted the challan. I have accepted the delivery. I have taken the goods in my possession, but I will make the payment on 30th of May, on or before 30th May, because I enjoy a 2 months credit period from that supplier. Now there is a question. What should be the period of this expenditure? Should this expenditure, which I will actually probably might pay in the month of May, will it be considered as expenditure of the year 1920 or 2021? Answer is, because the raw material has actually reached my factory on 30th of March, I have accepted, taken delivery of the raw material. This will be considered as expenditure of the year 2019-20, even though the actual cash outflow might happen in the month of April or May. This is accrual concept. That means even if you have not paid that expenditure, the expenditure has accrued. Accrued means it has become due. But according to your understanding with the supplier, You enjoy a 2 months credit period. You will pay after 2 months. That's all right. But then it has to be taken as expenditure of the last. Similarly, let's take another example. If you have sold certain goods on 30th of March, you have cut an invoice given to the customer. The customer has accepted supply of the goods from you. But then again, you have a 1 month credit period with him. He will make the payment to you in the month of April. Should I consider this as my income of the year 1920 or 2021? This will also be considered as income of 1920 because goods have already been supplied. He has acknowledged receipt of the goods. He has given you a promise, yes, I will pay in the month of April after enjoying a 1 month credit period. Therefore, this income will also be considered as income of the year 1920. On the basis of the concept of accrual, income has accrued. Income has become due, even though might not have been actually paid by the customer, but income has become due. Revenue has been recognized, and therefore this has to be treated as income of the last year, 1920. So all these are notes which I've already explained to you. This you can go through yourself. I will share the PPT with you, no issue at all. I've explained everything. All this I've explained. Then there is a time period concept. Time period is law requires every business to prepare a balance sheet and a profit and loss account every year for the period ending on 31st of March. Financial year, accounting year runs from 1st April to 31st of March. So every business is required to prepare a profit and loss account showing the position of income and loss and a balance sheet stating the position of assets and liabilities on 31st of March. What was the position of the business? Every business is required to have that kind of an accounting. Matching principle. If you consider income of the period July to December and you look at the expenditure for the period January to June and try to prepare a profit and loss account, it will not give you any indication at all about the state of affairs of your business. You know what I'm talking about? Very, very crude example, but then what I'm talking about is you take income of the first 6 years, the 6 months, you take expenses of the last 6 months, and then try to find out profit loss. This is ridiculous. Matching principle says you must consider income and expenditure of the same period of 1 month, same period of 3 months, same period of 6 months, same period of 12 months. Then only you can figure out and find out what is the actual profit or loss of the business. If you don't follow matching principle, then it is simply ridiculous exercise. You will not be able to find out the true position of the business at any given point of time. There are two methods of accounting which can be followed by businesses: cash basis of accounting or accrual basis of accounting. If you follow cash basis of accounting, in the examples that I had given you for 30th March sale and 30th March purchase of raw material, both the examples, in that case, the expenditure and income will be considered as that of the year 2020-21 if you follow cash basis of accounting. But if you follow accrual basis of accounting, then the last two examples, expenditure and income, will be considered as for the period 1920. That's the difference. So business has an option of choosing either cash basis of accounting or accrual basis of accounting, but accrual basis of accounting is more scientific and more acceptable in the marketplace. Even by the tax authorities, they will insist upon accrual basis of accounting, but theoretically speaking, there are two different systems of accounting available to you: cash basis of accounting or accrual basis of accounting.
Sir,
Yes,
uh, in case of accrual basis of accounting, so we
yes,
have considered something income or expenditure in the previous
Yes,
year, that is
yes,
before 31st March.
yes,
But in the
yes.
next year balance sheet, how do you take that into consideration? What you have taken in previous year?
Nothing, nothing. 1 year is over. I've closed my books of accounts on 31st March. Next year is a different story altogether. Nothing will happen.
So if we receive that time some income that we were supposed to receive in last year, we
Yes,
have to
please.
show it, right? In the next year of that we have received
No,
for
no, no, no,
previous
no.
year.
Receivable
So
payment.
that's where the difference between income and cash inflow comes.
Okay,
The
okay.
actual cash flow will happen in the year 2021.
Yeah.
But so far as income and expenditure concept is concerned, it will be
Yeah.
considered as income or expenditure of last year, 1920.
Okay.
That's where the difference is. Cash flow is different, income and expenditure is different.
Okay, sir. Okay.
Yes. So
But,
let's,
sir,
yes, please.
sir, we are using accrual basis accounting, no? Finally,
Anji?
we are using accrual basis accounting. Though there are two options, but we are using accrual basis accounting.
Yes.
Income tax.
Accrual basis of accounting is preferred choice and is also mandated by tax authorities. But a business can also decide to have cash basis of accounting. That's an option available. But most of the businesses, they adopt accrual basis of accounting in the market. So I propose a 7 minutes break here. Let's have a break of 7 minutes and then we come back. Can I start, please?
Yes, sir.
Yes,
Depreciation.
sir.
Yes, sir. Go
Yes,
ahead.
sir.
So depreciation is required to be charged on all tangible assets every year before calculating profit or loss for the business. Depreciation on every asset is required to be charged as per the rates of depreciation prescribed under the Companies Act as well as under the taxation rules. After charging depreciation only, you can find out true profit or loss for the business. But remember, depreciation is a non-cash expenditure. When you say I'm charging depreciation, it goes to reduce your profit, but there is no real cash outflow. It is not like paying salary to somebody. When you pay salary to your employee, money goes out of the business account into the account of an individual, but not in the case of depreciation. The money does not flow out of the business, but it has to be on notional basis considered as an expenditure. So depreciation is a non-cash expenditure. Similarly, I told you for if you consider,
I have a small question
yes, please.
regarding depreciation. For how long you can charge the depreciation for an asset?
Till the time the value, till the time 95% of the value of the asset doesn't get wiped out.
All. Yeah.
Till the time 95% of the value of the asset doesn't get wiped out, you keep on charging depreciation. Amortization concept is used when we treat a revenue expenditure as a capital expenditure, as I explained to you by way of example of the advertising campaign at the time of launch of a new product. Now coming to the basics of process of accounting. How actually accounting is done, even though it's slightly complicated, but I'll try to make it as simple as possible and just keep it to very, very basics, what is required by you as a basic understanding from the examination point of view. So there are two types of business transactions: cash, credit. Cash sale, credit sale, cash purchase, credit purchase. All the business transactions can be of two kinds, either cash or credit. Now, in accounting, we follow double entry principle. That is why the basic accounting that we follow in businesses is also technically called double entry bookkeeping system. Double entry bookkeeping system. There is a debit and there is a credit. There is a debit. For every debit, there is a corresponding credit. And for every credit, there is a corresponding debit. Every time you record a transaction in the books of account, it will always have two legs. Two legs. One account will be debited, one account will be credited with the same amount. So that at any given point of time, the total of debits will always be equal to the total of credits, because we follow double entry bookkeeping system, whereby for every transaction we make two entries. One account is debited, another account is credited. Therefore, the total of debits and credits at any given point of time will always tally. Now, all the various transactions that take place in the business, they are classified into three categories of accounts. Three categories of accounts. Personal account means accounts of individuals. Account of X, account of Y, account of A, account of B, C, individual. Real account means accounts of all assets and cash, plant and machinery, land and building, inventories, debtors, cash, all these are examples of real accounts. Nominal accounts are accounts of income and expenditure or profit or loss. So any transaction that takes place in a business, it can be classified into one of the three categories for sure. Depending upon the nature of transaction, it can be either a personal account or a real account transaction or a nominal account transaction or maybe a mix of the various accounts which are involved in a particular given transaction. So what are the rules by which the accounting is done? There is a debit, there is a credit. For every transaction, we have to understand which account will be debited, which account will be credited. So there are three rules that we have. There are three different types of accounts, and for each of the type of account of transaction, we have a different rule of accounting. If the transaction is of a personal account nature, one person is giving money to another person, then the rule that we follow is debit the receiver, credit the giver. If X gives money to Y, 5,000 rupees, Y is the receiver, then Y's account will be debited, X is the giver, X's account will be credited, amount will be same, 5,000 debit, 5,000 credit. So the rule of accounting that we follow for transactions falling in the category of personal account is debit the receiver, credit the giver. For real account transactions, the rule that we follow is debit what comes in, credit what goes out. Let's take an example. Suppose you sold goods worth rupees 20,000. What will happen? What is coming in? The customer will make payment to you. So cash is coming in. Therefore, cash account will be debited. Debit what comes in. What is going out? Goods are going out. Because you have sold the goods are going out. So the credit will be to goods account. So cash account will be debited. Goods account will be credited with the same amount. If the sale of goods was worth rupees 20,000, then debit 20,000, credit 20,000. That's how the total of debits and credits at any given point of time will always match, always tally. Another example. Suppose you have sold goods worth rupees 20,000 to X, but you have an agreement with him that he can take a credit period of 2 months to make the payment. Then what happens? I've sold the goods now. Payment will come 2 months later. At this point of time, what is coming in? Nothing is coming. Payment will come 2 months later. So which account is required to be debited? I will debit X. When I debit X, what it means is I have considered X as my debtor. A debtor is a person who has to make payment to me at a later point of time. Since the payment is not coming at this moment of time, I debit X. When I debit X, that means I make X my debtor. I have to receive payment from him. He will make payment to me 2 months later as per our agreement that I have given him 2 months credit to make the payment. What goes out? Goods are going out because they have sold the goods to X. Goods are going out. So in this case, the transaction entry will be debit X, credit goods. Amount will be same, 20,000, 20,000. Nominal accounts, the rule is debit all expenses and losses, credit all incomes and gains. Example, Suppose you pay salary for rupees 10,000. Now, salary is an expense. All expenses are required to be debited. So, debit will be salary. Credit, what is going out? Funds are going out. Cash is going out. If I'm paying salary to somebody, cash will go from the company account to that individual account. So, cash is going out. So, credit will be to cash. Debit, salary, credit, cash, amount will be same, 10,000, 10,000. Another example, suppose you receive interest, 20,000 rupees. Interest is an income. So it has to be credited because what is the rule? Debit all expenses and losses and credit all incomes and gains. Interest is an income. So interest account will have to be credited. In what form is interest coming to you? It is coming in the form of cash. So debit cash, credit interest, amount will be same, 20,000, 20,000. You need not go into details, but at least remember the three golden rules because there are questions coming in exam where they ask you what is the golden rule or what is the rule in accounting for transactions of real account. So then you will have to take debit what comes in, credit what goes out is the correct answer. So you have to remember this particular slide very, very carefully. But how to actually do it, you need not go into details because that's not prescribed in the syllabus and time also does not permit me for me to go into such detail.
Sir, one submission, sir.
Yes, please.
And will you explain again nominal account?
Nominal account is debit all expenses and losses, credit all incomes and gains.
In view of
That is,
company, sir. Nominal account in view of company or in view
yes,
of person?
nominal account includes all those transactions which are relating to incomes and expenses, such as salary, such as rent, such as traveling, such as interest. All incomes and expense transactions, they fall in the category of nominal account. And once you have a transaction of income and expenditure nature, then the rule that you follow is debit all expenses and losses and credit all incomes and gains. Accounting equation. Because we follow double entry bookkeeping system, whereby at any given point of time, the total of debit is always equal to total of credit. As a result of this, the total of assets will also always be equal to total of liability. That is why we say the two sides of the balance sheet. The two sides of the balance sheet are asset side and the liability side. They always match. The amount is always same. How does it happen? What is the magic? Magic is double entry bookkeeping system. I record every transaction, one as a debit, another as a credit with the same amount. So end of the day, when I prepare my balance sheet, the two sides of the balance sheet, whether be the asset side and the liability side, they will always match. They will always show the same number. What are assets? The resources owned by the business. What are liabilities? The debts of the business. What is equity? Owner's interest in the business. Equity means the amount of money that owner of the business has put in. If I started my business by putting 10 lakh of rupees, that's the equity. Assets are equal to liabilities plus stockholders' equity. Assets are equal to liabilities, but liabilities will have two components. One is liability, that means liabilities that have to pay to somebody else, or stockholders' equity. The money paid by the owner is also a liability for the business because of the concept of separate entity concept. If you remember the previous slide, the first concept of accounting was separate entity concept. That means business considers even the owners of the business as outsiders, as an entity different from the business. So from the business perspective, even if the owner has invested 10 lakh rupees, the business considers that as an outside liability. Therefore, assets of the business will always be equal to liabilities plus any equity that may have been contributed as initial capital by the owners of the business. Now, I may have started business in 2018 by putting in 10 lakh rupees. I earned a profit of 1 lakh in 2019. I earned a profit of 2 lakh in 2020. What is my total money in the business now? 13 lakhs. 10 lakhs was initial. Then I earned a profit of 1 lakh last year. Then I earned a profit of 2 lakh this year. Now my total stake in the company, now my total money in the company is 13 lakh. So I can also show this equation as assets are equal to liabilities plus capital stock. That means 10 lakhs initial capital that I had invested and plus retained earnings. That means the amount of profit that I've earned over the period of last 2 years, 3 lakhs. So total assets, 13 lakhs, total liabilities, 13 lakhs. But what is the breakup? Liabilities, capital stock, and retained earnings. All these three will have to be accounted for separately with a view to finding out what is the total assets and liability position of the company at a given point of time. So what are financial statements? There are two financial statements, profit and loss account and the balance sheet. Profit and loss account indicates the amount of profit earned or loss incurred by a business in a period of 1 year, and balance sheet shows the position of assets and liabilities of the business as at a particular time. These financial statements show two things: where a company's money came from, and second, where it went. So where got, where gone statement. Basically, where from the business got the money and where gone, where did the money go. Everything becomes clear once we look at the profit and loss account or the balance sheet of the company. Balance sheet is a snapshot of what a company owns and owes at a point in time. It is always prepared as on a particular date. The balance sheet prepared on 31st of March will show the position of assets and liabilities of the business as on 31st of March. The position of business will be different on 30th of March, will be different on 1st of April. Balance sheet is always prepared at a particular date so that it shows a snapshot position of what the business owns and what the business owes in terms of assets and liabilities at a given point of time. Balance sheet shows three things. What are the assets owned by the business? What are the liabilities owed by the business? And what is the equity? How much is the money of the owner which is invested in the business? The original money that owner would have invested plus amount of profit that he would have accrued, that he would have earned over the period of last few years. So assets will include cash, accounts receivable means debtors, inventory, buildings, equipment, intangible assets. Everything is part of your assets. Liabilities will show accounts payable. That means creditors. Creditors are people to whom business has to make the payment. You might have purchased raw material on credit basis and the supplier offered you 2 months credit. You got to make payment after 2 months. Supplier is your creditor. A creditor is a person who has to take money from the business. Debtor is a person from whom business has to take the money. And then, as I told you earlier, liabilities can be both short-term and long-term. The threshold that we consider in accounting is 1 year. If there is a short-term liability, it has to be for a period of less than 1 year. If it's a long-term liability, it has to be for a period of more than 1 year. Owner's equity will consist of two components: initial capital introduced by the business and reserves and surplus, means amount of profit that the owner would have earned over the period of last few years To that extent, your investment in the business would have increased. Then we look at profit and loss account. Income statement. Income statement is prepared for a period of time. Balance sheet is always prepared as on a particular date. Income statement shows the amount of profit or loss as a netting of income and expenditure, and as the company keeps on earning income and also spending money on a day-to-day basis, therefore, profit and loss account or income statement is prepared over a period of time. And then you consider what is the income of the company, both operational, non-operational. You consider what is the expenditure of the company, both cash as well as non-cash, and then find out what is the net profit or what is the net loss incurred by the business in a period of time of 12 months or 3 months or 6 months, whatever time the company is considering. So this is the general flow that we follow in preparing income statement. Sales means the income, total income, less cost of goods sold. Then you have gross profit. From gross profit, you subtract operating expenses, salaries, rent, travel, advertising, mobile expenses, internet expenses, stationery, everything you deduct. Then you have operating income. From operating income, you deduct interest. In case you have borrowed some money from bank or outside, you must be having to pay some interest. That interest has to be deducted. Then you get earnings before taxes. And then as for the taxation rules of the country, you pay tax if your income is within the taxable slab. After paying taxes, what is left is called earnings after tax or profit after tax. PAT or EAT, profit after tax, earnings after tax. This is the common flow that we follow when we prepare income statement or profit and loss statement. So first statement, balance sheet. Second statement, income statement or profit and loss account. Third financial statement, cash flow statement. In this case, we show the cash inflow and cash outflow happening in the business over a period of time. How will the cash flow into the business? By way of selling of goods or services, by way of selling of other assets. If you sell some machinery, you sell some building, you sell some furniture, money will flow into the business. How will the money flow into business? When you borrow money from somewhere, money flows into the business. How the money will flow furthermore? When you receive cash by way of investment made by the owners of the business. When owners of the business put in more money into the business, that will also go to increase the cash inflow of the business. How will cash outflow happen? When you pay for various operating expenses, when you pay for rent, pay for salary, pay for taxes, pay for interest, pay for lighting, all these will incur operating expenses. When you repay loans, when you borrow, that's a cash inflow. When you return the money, that is cash outflow. When you get money from the owners, that is cash inflow. When you return money to the owners, that's a cash outflow. So it's a simple understanding analysis of what are the various ways in which the cash is flowing into the business and what are the various ways in which the cash is flowing out of the business. Net of the two will indicate the position of cash flows to the business over a period of time. So from business perspective, profit is important, of course, but comparatively speaking, cash is more important. Even if the company is not making profit, is actually incurring loss for certain years, it can still sustain in the market. But in case the company has cash flow problem, it will be difficult for the business to stay in the market for a long time. Out of the two, cash flow is more important, even though profit is also important, but cash flow for a business is more important because without adequate cash flow, without liquidity, it will be difficult for the business to stay in the market on a long-term basis. Let's look at some of the multiple choice questions that you can expect in the examination. First question, financial statements are part of accounting. Balance sheet, income statement, cash flow statement, these are part of accounting. So the answer is option A. All of the following are functions of accounting except all of the following are functions of accounting except no, this answer is wrong here, sorry. Answer is A. Measurement is a function of accounting. Forecasting is a function of accounting. All of the following are functions of accounting. Functions of accounting except, yeah, the correct answer here is ledger posting. Ledger posting is a function of account. The question is wrongly worded. Accounting includes ledger posting. Ledger posting is the only function of accounting. All the other three are not the functions of accounting. I'll make correction there. Which of the following is not a subfield of accounting? Management accounting is a subfield of accounting. Cost accounting is a subfield of accounting. Financial accounting is a subfield of accounting, but bookkeeping is the answer here. Bookkeeping is mainly concerned with recording of financial data. So the correct answer here is A. Bookkeeping is mainly concerned with recording of financial transactions or recording of financial data. Sohan paid rent of rupees 5,000. So which account will be debited?
Rent.
This is debit. So we follow the principle of nominal account. Nominal account principle was debit all expenses and credit all incomes. So the answer here is rent account will be debited, cash account will be credited, 5,000, 5,000. That is how the accounting entry will be prepared. So the correct answer here is D. Financial position of the business is ascertained on the basis of accounting reports. You can't find out anything by the accounting process. Ultimately, out of the process, the output is the balance sheet, the income statement, the cash flow statement, and these accounting reports ultimately provide you indication about the financial position of the business. Financial statements don't consider, there was the monetary measurement concept in accounting in the slide that I had shown you. That means in accounting, we look into only those transactions which have monetary implication. If there is a transaction which cannot be measured in terms of money value, then it doesn't find its place in accounting system. Therefore, the correct answer here is assets and liabilities expressed in non-monetary terms. They are not part of the financial statement. Who are the users of accounting information? All of them. Creditors, yes. Lenders, yes. Customers, yes. So everybody wants to use the accounting information for the business. So the answer here is option D. All of the following are classified as fundamental accounting concepts, except business entity is a concept, going concern is a concept, accrual concept we talked about. Consistency is not an accounting concept. Consistency is an approach. What consistency means is that you got to follow a consistent accounting practice. If 1 year you have followed cash basis of accounting, you must continue to follow the same basis of accounting and not change over 1 year cash accounting, another year accrual accounting, third year cash accounting, fourth year accrual accounting. You should not do that. If you work like that, then accounts of 1 year will not be comparable with that of the other year. You must be consistent in your approach. If you decide to follow cash basis of accounting, that's good enough, fine, but maintain the consistency. If you decide to follow accrual basis of accounting, be consistent, follow accrual basis of accounting, henceforth. Two primary qualitative characteristics of financial statements are relevance and reliability. The financial statements balance sheet, income statement, cash flow statement must be relevant and they must also be reliable. So that somebody who looks at the balance sheet or income statement of the company should be able to truly find out what is the business position in terms of its financial health. The statement should be reliable and the statement should also be relevant. Kanika Enterprises follows the same method of depreciating machinery every year. This is based upon the concept of consistency. I want to be consistent every year. I don't want to change my method or rate of depreciation on a year-to-year basis. This is based upon the approach which is known as consistency approach. A purchased a car for rupees 5 lakhs, making a down payment of 1 lakh and signing a 4 lakh bill payable after 60 days. As a result of this transaction, what will happen? You have an asset of rupees 5 lakhs now because you have purchased a car, but minus 1 lakh rupee you have already paid cash down. So your total assets will now increase by 5 minus 1, 4 lakhs. The balance 4 lakh you have yet to pay. So the money is still with you. The money will become less only when you pay it after 60 days. As of today, what has happened is you have purchased an asset of 5 lakhs minus you have paid 1 lakh out of that. So your total net effect is your asset value has gone up by 4 lakhs. Income and expenses of same period should be considered for determination of profit. This is matching concept. Capital brought in by the proprietor is an example of increase in asset and increase in liability. Because cash brought in by the proprietor will increase the assets of the company because cash is coming into the business, but at the same time, because of the separate entity concept, because business regards owners also as an outsider, therefore it will also go to increase liability to the same extent. So the answer is option A, increase in asset, increase in liability. Assets are held in the business for the purpose of earning revenue. Revenue from sale of product is generally realized in the period in which sale is made, not cash is collected. If you are following a cash basis of accounting, then answer A will be correct. If you are applying accrual basis of accounting, then B will be correct. So normally most of the businesses follow accrual basis of accounting. On that basis, option B is the correct answer here. The concept of conservatism when applied to the balance sheet, accountants are conservative people. They believe in the dictum, they believe in the principle, anticipate no profits, but anticipate all losses. If there is an anticipation of a profit, ignore that. If there is an anticipation of a loss, the actual loss has not yet happened, but there is a possibility, anticipation, account for that loss. This is based on the concept of conservatism. Accountants are conservative people. When you follow this principle while preparing your balance sheet, what will happen is your assets will be understated. Your assets will be shown at lesser value because you are following the concept of conservatism. The determination of expenses for an accounting period is based on the principle of matching. The fair value concept is the underlying basis for stating fixed assets at their realizable value. Some companies follow fair value basis. That means they don't want to show the assets at the historical cost. They would like to show the assets at their current market value. If I were to sell my plant today, if I were to send my piece of plot today, how much value will I fetch? If you show the current value of all your assets in the balance sheet, then the concept is known as a fair value concept. Entity concept is the basic accounting concept. going concern, consistency, accrual are the fundamental accounting concepts. A change in accounting policy is justified. It is justified when there is change in the nature of business. It is justified when it helps in more appropriate presentation of financial data. It is justified when the law requires. So the answer is all of the above. The areas where different accounting policies can be adopted. You can have different policies for depreciation. You can have different policies for valuation of inventory. You can have different policies for valuation of investment. So the answer is all of the above. Selection of an inappropriate accounting policy decision. What will happen? It will not show true and fair view or true and fair picture of the business. It will either understate or overstate the performance and financial position of the business. Accounting policies refer to specific accounting principles as well as methods. So both A and B are correct. The correct option here is option C. The concept that business is assumed to exist for an indefinite period is known as going concern concept. Answer is option B, going concern concept. Outflow of funds to acquire an asset that will benefit the business for more than one accounting period is referred to as capital expenditure. Capital expenditure is such expenditure which acquires an asset which will give service to the business for a long period of time. That is why it is called capital expenditure. Which of the following is the purpose of preparation of trial balance? To check the accuracy of accounting, to ascertain the balance of any account, to facilitate preparation of balance sheet, profit and loss account, and the cash flow statement. So the answer is all of the above, option D. An amount spent for replacement of worn out part of machine is a revenue expenditure. Rent paid to landlord is credited to rent paid. So this is a nominal account transaction. Debit all expenses, credit all expenses, credit all incomes. Rent paid to landlord. So landlord account is credited, cash account will be, landlord account will be debited and cash account will be credited. Which fundamental financial statement represents the accounting equation? Assets are equal to liabilities plus owner's equity. This is balance sheet. Answer is option C. Which account is the odd man out? Office furniture equipment is a fixed asset. Freehold land and building is a fixed asset. Plant and machinery is a fixed asset. Stock of raw material is a current asset. So the odd man out is option C, stock of material. Bills payable account, that means creditors. What kind of an account is this? It's a personal account. Rent account is a nominal account. Proprietor's account is a personal account. In double entry system of bookkeeping, every business transaction affects two accounts. One account will be debited, one account will be credited. So for every debit, there will be a corresponding credit, and for every credit, there will be a corresponding debit. A sale of goods to Ram for cash should be debited to cash account. Cash account will be debited, goods account will be credited here. The transaction will be based upon the principle debit what comes in, credit what goes out. So cash is coming in, so cash account will be debited. Answer is option B. A withdrawal of cash from business by the proprietor. Withdrawal of cash. Cash is being withdrawn. Money is going out. So credit will be cash account. Option C is the answer. The process of transferring items from journal to ledger This process is called posting. Posting of entry from journal to ledger. The process is called posting. Journal and ledger record transactions in a chronological and analytical order. Option A is the answer. Both journal and ledger record financial transactions in a chronological order and analytical order. Ledger book is also known as principal book of account. The technique of finding the net balance of an account after considering the totals of both debits and credits is called balancing of an account. You look at what is the total of debits, you look at what is the total of credits, find out the difference. Either debit will be more or credit will be more. How do you find this difference? By balancing of an account. These are some of the sample multiple choice questions that you can expect in the examination. So even though the subject of accounting is very detailed, very deep, but you need not bother about that. You are only required to have a basic understanding. So my presentation here and plus some sample question, that should be enough for you from the exam perspective. You can expect minimum of 3, but maybe 4 questions from this particular section. That's where I close my session. Thank you very much. I really enjoyed talking to you during this particular session as well as my session yesterday. Thank you very much.
Thank you so much, sir. Thank you very much. And thanks to all participants.